Welcome to CryptoCore, your cryptocurrency navigator. We are diving into a rapid analysis of the crypto market dynamics as of 12:01 a.m., Tuesday, November 25th, 2025.
Today's market narrative is really dominated by one theme: a technical bounce, a big one, fueled by a sudden liquidity injection. And it's happening right in the middle of, well, extreme fear.
That's the key takeaway right there, isn't it? After days of really sharp declines, Bitcoin has clawed its way back above the $88,000 level.
It has.
But what's really striking to me is Ethereum. It's surged over 5%. This suggests we might be entering, a short-term base building phase.
It could be. But, and this is a big but, we have to remember where we came from. We are still deep within a corrective zone compared to that $111,000 peak we saw just a month ago.
A very good point.
Exactly. The psychological indicator, the fear and greed index, it tells us investors are still in extreme fear territory. Yet you see this massive surge in trading volume and the rising Ethereum dominance. And that gives this rally some credibility.
So our mission today is to analyze whether this is, merely a tactical short squeeze or could it be the beginning of a genuine trend reversal? Maybe driven by those renewed Federal Reserve interest rate cut expectations.
That's the million-dollar question.
Before we get into the numbers, if you find this deep dive valuable, please hit the like button. That support helps us immensely as we work to bring you this fast and accurate daily market intelligence.
So our deep dive today is structured like this. We'll start with a detailed analysis of the overall market health indicators. Then we'll move into the specifics of the BTC and ETH markets.
And after that, we'll cover the most critical overseas news, break down the technical levels, and finish up with key trading observation points and our overall market outlook.
Right. And since we produce this content daily, some of these essential foundational metrics might be repeated, but they are absolutely crucial for understanding the current market context.
We strongly encourage you to stay with us, especially for those later sections where we get into the technical outlook and our market forecast. Some really important stuff in there.
Okay, let's get into it.
Let's jump straight into section 1, the overall market landscape and key metrics. And as a reminder, if you feel the pace of our conversation is too fast or slow, you can always adjust the playback speed in your settings.
Starting with the big picture, the total market cap. Today, the market capitalization stands at $3.03 trillion.
And recovering that 3 trillion threshold is a big psychological win, isn't it? That's a gain of 0.07 trillion, or about 2.36%, compared to yesterday's 2.96 trillion.
It is. It signals a notable easing of that short-term selling pressure that pushed us below that level in the first place.
But let's add the long-term context. A month ago, on October 25th, we were looking at a market cap of 3.74 trillion.
Right, so we're still talking about a contraction of about 19%. This rebound really needs to prove itself. Is it just a technical relief rally and a much longer correction, or is this a true turning point?
A question that leads us right to the power dynamics between Bitcoin and Ethereum, measured by dominance. Bitcoin dominance, according to TradingView, is at 58.76%.
And that's a drop of 0.51% from yesterday's 59.27%. But here's the crucial part. Ethereum dominance, based on CoinMarketCap, rose from 11.40% yesterday to 11.80% today.
Wow, so a jump of 0.4%. That's the first major signal of asset rotation. We have to track them.
It's a huge signal. It strongly suggests that this rally isn't being led purely by Bitcoin stabilization. It's about aggressive short-term capital moving into higher beta assets, specifically Ethereum and the major altcoins.
Which I assume is confirmed by the CMC20 index.
Absolutely. The CMC20, our tracker for the top 20 altcoins, it confirms this directional shift. It rose from $182.86 to $187.87 today. That's a 2.74% increase.
So the CMC20 gain outpaced the total market cap growth.
Exactly. Since 2.74% is higher than the 2.36% growth of the total market, it clearly indicates that the upper tier of altcoins drove the day's recovery momentum.
Okay, now for the investor psyche. The fear and greed index still registers 12. Squarely in the extreme fear zone.
Yes, and it's only a modest bump up from yesterday's 10. It confirms that emotionally, investors have not yet recovered from the shock of that sharp sell-off.
It's a lagging indicator for sure.
It is. And paradoxically, the altcoin season index actually dropped slightly from 25 to 23.
That's strange, even with Ethereum showing so much strength.
I know. It shows the broader market just isn't ready to declare a full alt season. It's interesting to note that even during the October high, this index was only around 24, and last week it was at 30. The fact that it remains stubbornly low highlights this underlying caution towards smaller cap risk.
But the technical release valve certainly fired. I mean, look at the average crypto RSI. It exploded, soaring a massive 10 points from 43.98 to 53.98.
That is a critical technical signal. Crossing that 50 level means we have decisively exited the short-term oversold condition and moved back into neutral territory. That sharp recovery indicates strong buying power. Just absorb the liquidation shock almost instantly.
And that rapid absorption is reflected in the volume, right? Total 24-hour trading volume surged 32.5%.
Yeah, from $122.59 billion to $162.43 billion. That jump in volume gives this price bounce legitimacy. It's not just some thin market artifact, it suggests significant capital entered the market.
Either new buyers seeing a discount or shorts covering their positions.
Precisely. And while this is lower than the $200.75 billion in volume we saw last Tuesday, the post-weekend recovery is highly encouraging.
So what about the big money? We have to look at institutional engagement. Let's analyze the latest ETF flows based on the November 21st data.
Right. So institutional flows were brutal over the last month. They logged $4.9 billion in outflows, one of the worst periods on record. That's the long-term narrative.
But the daily data
for November 21st provided a crucial flicker of hope. A total net inflow of $294 million. Bitcoin ETFs accounted for $238 million of that, and Ethereum ETFs saw $56 million in net inflows.
So that's the first real indication that institutional buyers are finally stepping back in, interpreting these prices as a discount.
It seems that way. Now, shifting to derivatives, what are the key takeaways from open interest and funding rates?
Well, the perpetual futures open interest is pretty steady at 800.25, dropping just slightly by 0.9. So leverage hasn't ballooned uncontrollably.
Right, but what's most telling is the funding rate. It flipped negative to minus 0.004%.
What does that tell us?
It tells us that despite the price increase, the majority of speculators are still betting on a downside. They are heavily short. This creates the perfect environment for a powerful short squeeze. If the price holds or rises further, those aggressively short positions will be forced to cover, creating a very sharp upward move.
Okay, last two for this section. The Puell multiple and implied volatility.
The Puell multiple is sitting at 0.81. This suggests miner profitability has deteriorated significantly, and it's approaching the historical capitulation zone. Historically, this level signals a potential long-term accumulation bottom.
And volatility.
Implied volatility, which tracks option market expectations, it remains high. BTC is at 55.95 and ETH is at 80.09. While that's down slightly from yesterday, the market is bracing for substantial price swings in the near future, particularly in Ethereum.
Okay, let's move on to section 2 and dig into the specifics of the Bitcoin market. Today's price is $88,270. That's a 1.69% increase from the day before, bringing the market cap to 1.7613 trillion.
Recovering 88,000 is important, and we saw that 24-hour trading volume of 74.3 billion, a 28.15% surge, which really validates that price rebound.
The daily volatility was just intense. We moved from a low of $85,533 to a high of $89,195. That's a spread of 4.28%.
That wide range confirms heavy action at the $85,000 level, where buyers just vigorously defended that support zone.
So to put this bounce into perspective, 7 days ago, on November 18th, the price was $92,051. We are still 4.1% lower than last Tuesday.
True, but the bounce has massively eased the pain. Last week at this time, our 7-day decline was a painful 13.15%. Now it's reduced to just 4.16%, so a huge improvement in the short-term trend.
But the shadow of the deep correction definitely remains. Compared to the one-month high of $111,002 on October 25th, Bitcoin is still down roughly 20.5%.
And that is the narrative clash we're seeing. Short-term relief versus a severe medium-term adjustment. If we look at the broader performance windows, today's figures show the 30-day return at minus 20.94%, the 60-day at minus 19.04%, and the 90-day at minus 21.05%.
It's clear that the midterm trend is consistently negative then. It's hovering around that 20% loss mark across the last 3 months. Even year to date, we're still negative at minus 5.57%.
The market has really endured a prolonged consolidation phase after failing to break new highs. Now, if we dig into the underlying network activity, on-chain data confirms this recent crash was driven by a panic sell-off in Bitcoin, not some kind of Ethereum collapse.
How much leverage was wiped out?
Approximately $2 billion worth of leverage was liquidated in a single day. Some analysts have termed this a zebra market.
A zebra market? That sounds dangerous.
It refers to a period of exceptionally high volatility and rapid, jagged price action, driven by cascade liquidations. It's volatile, aggressive, and usually short-lived. Crucially, though, these massive leverage purges often serve to cleanse the system, which can contribute to a more stable short-term base.
And we're seeing some conflicting signals from institutional treasuries as well. While the ETFs log those huge outflows, we saw BlackRock strategically deposit $321 million worth of Bitcoin onto Coinbase Prime.
This is significant. It suggests either a change of hands among large institutional holders or maybe a strategic pre-positioning by BlackRock to meet anticipated future demand. Despite the general fear, it seems the largest players are still accumulating.
And of course, the most stalwart of holders, MicroStrategy, continues to buy. Despite its stock plunging 60% and those rumors of JP Morgan shorting their shares, Michael Saylor doubled down.
He did. He purchased an additional $836 million worth of BTC. Saylor's unwavering conviction really does maintain a psychological floor for many long-term investors.
But there is a counter-argument to that, isn't there?
Yes, there is. Some sources suggest the emergence of these spot ETFs is stripping away the scarcity premium that was once enjoyed by corporate Bitcoin debt, or D-Day. And this has prompted a valuation readjustment for firms like MicroStrategy.
If this deep dive is proving helpful, please consider supporting our data compilation and analysis by clicking the heart-shaped thanks button below and treating us to a coffee. It really helps fuel our daily research efforts. Now let's move to Section 3, the detailed analysis of the Ethereum market.
Ethereum is absolutely the star performer today. It surged 5.43% to $2,953. This is significantly stronger than Bitcoin's 1.69% rise, and its market cap hit $356.4 billion.
That 5.43% surge from yesterday's price of $2,801 confirms very strong demand at that $2,800 support level.
And the daily volatility was even higher than BTC's. It hit a 7.7% spread between the low of 2,768 and the high of 2,981.
So Ethereum's resilience in the short term is undeniable. We're only 2.3% below the price we saw 7 days ago.
More strikingly, our 7-day decline rate has shrunk dramatically to minus 2.43%. That actually beats Bitcoin's minus 4.16% recovery rate. And just to remind you, last Tuesday, the 7-day decline for ETH was a staggering 15.22%. This demonstrates an incredibly swift turnaround.
But let's apply that medium-term filter again. Ethereum's 30-day decline is minus 25.33%, and the 90-day decline is a massive minus 35.83%.
And this contrast is crucial. While Ethereum is strong now, its medium-term correction has been far deeper than Bitcoin's, which was only around minus 21% over the same 90-day period. This indicates that while the ETH supply reduction mechanisms are working, the overall selling pressure on Ethereum was just intense in the last quarter.
On-chain data suggests that, historically, when BTC dropped 30%, ETH would typically drop 40 to 50%. But this time, the gap was much smaller. Why the difference?
Well, analysts point to the EIP 1559 burning mechanism and the substantial increase in state ETH. These structural changes have reduced the effect of circulating supply, mitigating the sudden market shock and providing a stronger structural floor for the asset.
We're also seeing those classic contradictory headlines. On the one hand, bearish news reports a 300% surge in selling activity from long-term holders,
Signaling potential capitulation, right?
and yet bullish news shows an institutional buyer, Bitmain, led by Tom Lee, aggressively bought up to 3% of the total Ethereum supply.
This confirms a massive transfer of wealth is happening. Institutions like Bitmain view this price range as a core accumulation zone, and they're buying up supply from long-term holders who are exiting in fear.
And the options market.
It's bracing for more action. Ethereum's implied volatility is at 80.09. It's still significantly higher than Bitcoin's 55.95, meaning options traders are predicting far more dramatic price movement for ETH moving forward.
Now we move to Section 4, Critical News Analysis. And we are sharing data compiled and analyzed by CryptoCore from various media reports over the last 24 hours.
First up, the major macro shift. Federal Reserve policy. Recent comments from Fed Governor Christopher Waller strongly supporting interest rate cuts have pushed the probability of a December rate cut to above 70%.
And the implication for the crypto market, I mean, despite worries about a softening job market and the strong dollar, this growing expectation of renewed liquidity is acting as a major support for the market floor, right?
Exactly. The anticipation of cheaper money just fuels risk-on sentiment across the board.
This leads directly into the conflicting narratives around Bitcoin's bottom. You have the bullish voices like Arthur Hayes and Max Kaiser who believe the $80,000 level will hold as the floor.
Right, and they're anticipating improved liquidity once the Fed ends its quantitative tightening, or QT. They suggest increasing bank lending will further support this liquidity wave.
But caution is widespread. We see reports from institutions like Deutsche Bank and several prominent influencers who are warning that macro deterioration could lead to a classic bear market entry, keeping the possibility of more downside open.
The market is deeply divided on the direction from here, and Ethereum faces similar internal conflicts. On the risk side, you have that massive spike in selling from long-term holders and the technical threat of a death cross, suggesting more pain ahead.
But on the other side,
Bullish analysts are eyeing a potential ascending third wave pattern if $2,800 holds. And Bitmain's aggressive buying reinforces this as a key accumulation range for institutions.
the ETF narrative is also incredibly complex. We saw that $4.9 billion outflow, which recorded the worst month in crypto fund history and severely damaged short-term sentiment.
Yet I think BlackRock's actions speak louder than the retail outflows. Their deposit of $321 million in BTC and $102 million in ETH onto Coinbase Prime during this period suggests they are either rebalancing portfolios or strategically building reserves for future client demand.
It's a strong signal of institutional long-term conviction amidst short-term retail panic.
It is. Now, globally, regulatory focus is tightening. The European Central Bank, the ECB, warned about stablecoin risk if they become too deeply intertwined with traditional finance. Meanwhile, Japan's Financial Services Agency, the FSA, plans to require exchanges to hold mandatory reserves to prepare for hacking incidents.
So regulators are focusing heavily on risk mitigation.
They are. And here's an interesting piece of news that shows the network's resilience. Despite China banning mining back in 2021, underground operations now account for 14% of the global Bitcoin hash rate.
So China is the third largest mining nation again.
That's right. It just underscores the decentralized nature of the network. Now, mining profitability is currently squeezed due to the record hash rate and lower price, but some companies are pivoting toward high performance and AI computing, which is actually driving up their stock prices.
Shifting to the crucial Korean market. There are reports that Naver is planning to acquire Dunamu, the operator of the Upbit exchange, valued at roughly $14.5 billion.
A huge story. And that could precede a NASDAQ Q listing. This is really boosting expectations for official institutional integration in the Korean market.
However, regulatory scrutiny remains high. The Korean FIU is reportedly preparing to sanction other major exchanges, including Bithumb and Koinon, for alleged anti-money laundering violations.
So it's a period of intense corporate opportunity mixed with some serious regulatory risk.
And political events continue to impact volatility. We saw Bitcoin briefly rebound above $88,000 following a positive public report from President Trump regarding a call with President Xi Jinping.
On a more personal financial note, that recent crash is estimated to have resulted in about $1 billion in paper losses for entities tied to the Trump family. It just highlights how intensely geopolitical and macro events are woven into the volatility of this asset class.
And we have to reiterate MicroStrategy's stance. Despite the stock plunge and short-selling rumors, Michael Saylor's decision to purchase another $836 million of BTC just reinforces his commitment.
It's a defiant move, absolutely. But as we mentioned earlier, the debate continues about the declining scarcity premium on their corporate Bitcoin debt instruments, thanks to the emergence of these readily available spot ETFs. It's forcing a reevaluation of their core value proposition.
Okay, moving to Section 5, let's quickly analyze the technical perspective to understand where the market is positioned right now.
All right. Based on the current Bitcoin price of $88,270, the 14-day Relative Strength Index, or RSI, is attempting to cross back above 50. It bounced hard from oversold territory.
And breaking that 50 level is key for confirming a short-term transition to buying dominance, correct?
That's the key. Now, looking at the exponential moving averages, or EMAs, the current price is below both the 20-day and 50-day EMAs, with a death cross still technically in effect. This confirms the medium-term trend is still bearish.
So any sustained move higher is going to face some serious headwinds.
Oh, absolutely. The cluster of EMAs between $90,000 and $92,000 will serve as formidable resistance. On the MACD, the histogram is contracting in the negative region. If we see a bullish cross of the signal line, that would be a decisive short-term reversal signal to watch for.
And what about chart patterns?
The analysis is pretty split right now. Some are looking at a potential cup and handle formation on the weekly chart targeting 90,000 and above, while others are warning of the ongoing death cross risk in lower timeframes, urging caution.
And for Ethereum at $2,953.
The technical outlook there is a bit sharper. Its RSI shot up aggressively, moving from oversold below 30 to the 45 to 50 range. The upward slope is much steeper than Bitcoin's.
We also saw the 4-hour stochastic oscillator confirm a golden cross.
Yes, and that issued an immediate short-term buy signal for Ethereum. Now, using the Fibonacci retracement from the recent high of $3,400 to the low of $2,768, the price is currently testing the 0.382 retracement level. That's right around $3,000.
So holding and consolidating above 3,000 is the critical factor for a trend reversal.
It is. Failure there risks a retest of $2,800 or even a drop down toward $2,500.
Okay. Given the current volatility and all these mixed signals, let's identify the 3 core trading observation points for the days ahead in Section 6.
All right. The first is Bitcoin's ability to defend these key price levels and stage a breakout. The defense of $85,000 is paramount. Arthur Hayes' $80,000 bottom theory really relies on this general area holding firm.
And we have to acknowledge the downside risk. If 85,000 fails, the market could slide toward that liquidity zone between $75,000 and $79,000.
We do. On the upside, breaking and stabilizing above the $90,000 resistance is absolutely essential to build momentum for a genuine challenge back toward the $100,000 mark.
The second point is that negative funding rate and the high potential for a short squeeze. The current negative rate of minus 0.0004% means traders are aggressively defensive, building short positions.
And that creates the best possible setup for a rapid parabolic move. If the price manages to consolidate or even just drift higher from here, the resulting mass liquidation of short positions, a short squeeze, will amplify the rise.
And the options market seems to agree.
It does. The elevated implied volatility in the options market further indicates that this sharp, explosive movement is precisely what smart money is anticipating.
And our final trading point involves institutional money, consistent ETF flow, and Ethereum's $2,800 resilience.
Yes. We need to see if the recent one-day positive inflow can transition into a sustained 3-day run. The key is confirming that BlackRock's large deposits are translating into actual buying pressure, not just some internal reshuffling.
And Ethereum.
The $2,800 support level for Ethereum is acting as the security blanket for the entire altcoin market. Maintaining Ethereum dominance is an absolute prerequisite for any substantial altcoin market recovery.
Okay, in our final section, let's synthesize all this information into a comprehensive market outlook and some future scenario planning.
In the short term, I think the bias leans toward the continuation of this bounce scenario. The technical factors, the negative funding, the leverage cleanup, and the successful $85,000 defense all suggest that the immediate bad supply has been absorbed, establishing a temporary floor.
So what are the near-term targets we should be watching for if this momentum holds?
Bitcoin is likely aiming to reclaim $90,000, with a potential move toward the $94,000 to $96,000 range. Confirmation of that move would suggest that this recent severe downturn was indeed a healthy mid-cycle correction rather than a shift into a full-blown bear market.
And the medium-term momentum hinges almost entirely on the Federal Reserve, doesn't it?
It really does. The rising probability of December rate cut and the expectations regarding the end of quantitative tightening are providing a powerful catalyst. This creates the potential for a strong liquidity resurgence, which aligns with projections from analysts like Arthur Hayes.
If global dollar liquidity improves, Bitcoin could very quickly attempt new all-time highs.
It could. And furthermore, positive corporate news, like Naver's potential acquisition of Upbit, could accelerate institutional capital flows in major markets.
But risk management is always paramount. We have to consider the potential for a deeper decline.
Always. If macroeconomic indicators rapidly deteriorate, or if ETF outflows resume and intensify, a collapse of the $80,000 support line could plunge the market into a deep and prolonged recession. So in conclusion, the market's direction will be determined by the successful convergence of three critical factors.
Bitcoin's defense of 85,000.
Ethereum's resilience above 2,800.
And a favorable shift in Fed liquidity policy.
That's the trifecta.
To summarize today's deep dive from CryptoCore.
The market found a strong technical base today. We saw a recovery to 88,000 for Bitcoin and a powerful surge from Ethereum, all occurring while the market fear index remains stalled at 12 in extreme fear.
And the massive surge in trading volume suggests low-cost buyers have entered the market, while that negative funding rate sets the stage for a potential high-impact short squeeze, contradicting the overall fear sentiment.
For traders, the focus is squarely on holding the $85,000 support for Bitcoin and 2,800 for Ethereum. A successful defense of these zones could propel the market toward the upper $90,000 range, capitalizing on those year-end liquidity expectations.
That concludes today's analysis. CryptoCore strives to be your cryptocurrency navigator, providing the fastest and most accurate analysis of the latest market trends every single day.
So please ensure you subscribe, like, and turn on notifications so you don't miss tomorrow's update from the CryptoCore team.
We would like to acknowledge the sources for the articles cited in today's material.
We reference a total of 17 articles, including CoinSpeaker, published on November 25, 2025, titled Arthur Hayes Forecasts, BTC Drop Below 80K. Crypto Briefing from November 24, 2025, titled BlackRock Deposits 321 Meters in Bitcoin, and The Defiant from November 25, 2025, titled Bitcoin Clears $88,000 After Trump Sheet Call.
Please refer to the respective media sites for detailed content.